Welcome to Retirement Unlimited. I'm Jeremiah Lee, and this is Randy Barkley. We're both certified financial planners. I'm also a California licensed attorney. We work together at Tricord Advisors, where we help clients build the life they love.
Last year, my conversation with clients is we talked about asset allocations, and my conversation was that bonds were the riskiest asset in the entire portfolio. And I talked about the potential for rising interest rates. Little did I know that they were risky. They became, in some cases, toxic,
right?
Because they've had the worst performance in my professional history. I've never seen it this bad, and I think it's just a reaction to the rising interest rates. In some cases, it's probably an overreaction, but I think we have a market correction that has been really, how do you want to say it? It's been realized here, and it's hard to sit down with clients when you look at total performance and you see that particular asset class, which is supposed to be stable, has underperformed equities in a lot of cases. So this year's been a real interesting time to realize what rising interest rates will do to a portfolio.
Yeah. And bonds, talking about bonds, bonds aren't the most enjoyable thing that people always talk about, but they have been so interesting this year. And so I think detrimental to people. And classic portfolio theory, when people build a portfolio, they put some bonds in there and they put some stocks in there.
Right.
And they think the two will balance each other out. That when, bonds, when stocks are doing great and the market's thriving, bonds are just stable. And when the stocks come down and the bonds will give buoyancy and give support, that's been the classic theory. And that when that modern portfolio
theory has been a standard for decades.
Yeah, it's back in the 50s and 60s.
It's not something that is novel.
Yes.
This is something that's been around for a long, long time, and you put bonds as a buoyancy to kind of hold value.
And that used to work when those two assets were, they call it negatively correlated, meaning one goes up, the other goes down.
Right.
It keeps you even. That was how the theory was built. Well, over the decades, people have been doing this. It's been consistent. Those two assets are no longer negatively correlated in the same way and or correlated to the same way that life exerts itself.
Yeah.
So we see those assets moving together. And March 2020 was a big moment where bonds came down and also stocks came down. Everything came down together.
Right.
So where does that leave us? Where was the buoyancy?
And we looked at that and said, well, what's the other correlation? What do we put money into that is not going to follow the market down?
Right.
Those particular classes down. Right.
Yeah. And we made adjustments. We'll talk about the alternatives that people use that we use. But one of the big questions that happened in this year, you get to the beginning of the year, say interest rates are going to rise. Everyone kind of saw that we're going to have higher interest rates. We didn't know how much, we didn't know how fast. We knew we were going to have some.
And we made adjustments. I mean, we made adjustments in our portfolio. We shortened the durations. I mean, a bond, for our listening audience, a bond is rated based on its credit worthiness. So you have the highest rating is treasuries, and you go all the way down to junk bonds. And means there's no collateral support.
Yeah, what risk there is, right?
What risk is. And then the other key factor you look at is duration. What is the length of the maturity?
Right.
So if you buy a bond that's maturing in 30 days, that has a lot less risk than if you have a bond that is maturing in 30 years.
Yeah.
And that's a big difference.
Yeah, that's right. We compare it to the two of us. If I owed you $5 and I was going to pay it to you tomorrow, the risk that I'm not going to be able to pay you tomorrow, well, that's fairly low. If I said I'll pay you $5 in 30 years, well, a lot could happen. There could be a car accident. There could be all sorts of things. Similar with bonds. When it's a very long duration, there's a lot that could happen between now and then. So there's more risk.
And typically the longer duration bonds are they are owed a higher interest rate. So one of the things that we look at is different bond yields. So we're looking at a 2-year versus a 10-year versus a 30-year.
Yep.
And right now the short term is earning higher interest rate than, like, a 2-year bond on a treasury is earning higher interest rate than a 10-year on a treasury.
Right. And that's the shocking moment, right? That's the idea. If I need to borrow money from you for a day, no big deal.
Right.
If I need to borrow it for a year, well, hey, I might need that money. So I'm going to have to charge you more interest. That's the idea. And just like you said, historically, the shorter the time, shorter the duration, the lower the yield was, the lower the interest rate had to be. Well, we've inverted. We've gone the other way to say,
and that's a big deal. Inversion is a big deal.
Yes.
We'll talk more about that as we get later in, further into the program.
Yeah.
But that inversion is a big deal,
right? And a lot of people, that's a telltale sign. It's a trigger. It's a known sign that we're heading into a recession. That's where we're headed. But that moment where we say, if you only want it for a couple of days, you have really high interest rate. But if you want to borrow it for 3 years, it's no big deal. Don't have to charge much. That's odd. That's the opposite.
Right.
And it's similar when people take like a 15-year mortgage or a 30-year mortgage. Usually a 30-year mortgage has a higher interest rate.
Right.
And the 15-year has a lower interest rate, usually.
Usually.
It's weird in this moment with inversion. So with bonds, they came down. I had some numbers here. I wrote down that long-term treasuries came down 34% at one point this year.
34%. Now these are the safest. These are considered the safest assets.
And the longest, these are the 30-year plus. These are the really long
ones. These are U.S. government secured.
Yes.
But it has everything to do with the duration and what's going on within the market with interest rates rising.
Yep.
So they got, again, like I said, it's not just that they had a negative year. They were toxic in some cases.
Yep, for a portfolio. And imagine holding that where stocks have come down and the stable part of your portfolio came down 34%. That's miserable. That's the worst case. The stock market in that same period, this is when the market was down 21%. And that was earlier this year. Market had come down, bonds had come down. The most people experience, if they're like a core bond holding, one of those ETF type accounts, they were down 15 to 20%, which is still massive for bonds. We had a number of clients who were still down 9% in their bonds. That was not an odd.
Again, and to be very transparent, we shortened our durations. We fully expected that bonds would come under pressure. Initially, in the start of this year, we thought maybe they would start increasing at 1/4 of a point per the Fed meetings, but they came out of the blocks increasing by 3/4 of a point, so 3 times greater. And we had already shortened our durations, thinking that we would get ahead of the rising interest rate within the marketplace to protect capital. So at that point, we had to really analyze our holdings. We had to make some decisions. But for a client to look at it and say, oh my goodness, the total return is down. What am I going to do? The best advice that I've had over the last 40 plus years I've been in this business is bonds will heal because the interest will continue to be paid. And as you get closer to that maturity date, they'll get paid off if the borrower is a creditworthy borrower, right?
Which most of the issues here is we're not talking about defaults. We're not talking about that. Of course, can happen. That does happen.
It's market fluctuation.
Yeah, but what's happening in the market is not that companies are going out of business and defaulting on bonds, and that's causing things to change. It's the interest rates. That's kind of the driver of a lot of this, of why we're getting to where we are. And so as this stuff comes down, like you said, you have to take a good hard look at the portfolio. And a few weeks ago, anyone who missed the episode, we did an episode on what if I knew the future? What if I really knew what was about to happen? Will that even help you? Would it even make it better? And looking back, had everybody known, had the world known that bonds were going to be so difficult this year, would people just move to cash? Would people shorten the duration as, not just 1 to 3 months, but much shorter? The hard part is in hindsight, you always say, yeah, I would have done more. I would have done differently. In the moment, us and many others like us, they made what they thought was very good strategic moves, and they were in the right direction. It's just the magnitude of how poorly bonds have done.
And I think we have to the underlying reason for all this is that the Federal Reserve, and I'll put it on the shoulders of Jerome Powell, he started to really see that inflation was not going to just disappear on its own, that there was some stickiness, that was some enduring aspects of inflation that he was concerned about. And he has been very clear through this year in all of his public statements, he wants to bring inflation down. And I think the markets, they're trying to look for the under the rock, so to speak. Does he really mean that? Well, I think he really means that. I think for sure he wants to see inflation down around 2% again. And
he's been kicking it with increases in the interest rates, and he will continue to. We'll probably have another one here in December. We'll see where it keeps going. So the next question, kind of the pivot a little bit, is they've done poorly. A lot of people realize that in their portfolios. Well, now what? Are they going to do better? Are they going to do just as bad again next year? Will 2023 be the year of the bond? What are your thoughts of where we're at and where we're headed? I mean, we don't know the future, what they're going to do, but where do you see bonds now? How do you think about it?
I guess the key issue for us, the information I look at is inflation. How bad is inflation? And we're starting to see inflation come down in some key areas. I think that will temper the rate of increases that the Federal Reserve is anticipating or will probably enact over the next year, going into 2023. Now, again, not knowing the future exactly, but I don't see inflation continuing its upward spike.
Yeah.
I think it'll start to come down, but will it reach the level that the Federal Reserve wants it to be at by sometime in 2023? My sense is no, it probably won't. But for clients who have bonds, there will be improvement.
Yeah.
There will be improvement in their pricing. So if you're looking at total return, if you have a portfolio right now that's just been really come under a lot of pressure because of the rising interest rates, my suggestion to you is you don't just sell it. You hold on and you wait for interest rates to kind of temper, and then take a reevaluation once we've kind of lowered this expectation of rising interest rates.
We know everyone's different. Everyone's portfolio is different. They should always check with an advisor and get their situation looked at. But the idea being that bonds had a really tough year this year, and based on interest rates and where we're at, they likely won't have as tough of a year next year.
Yes, what you and I refer to as regression to the mean. And the mean means what's the par value of something.
Yeah.
Well, bonds are so far off from what they would normally be. Yeah. There's probably going to be some, I'm going to say, getting back to some kind of normal structure to them. I don't think it's going to go all the way back, though. I don't think it's going to recover everything that went down.
And that's a good comment. There's a lot of folks or a lot of advisors who will say, okay, you have this stock, it's down, hold on to it for the idea that it's going to recover.
Right.
Bonds are going to take a long time to recover, to get back to the January 20.
The longer the duration, right?
Yeah, the long duration bonds are going to take a long time to get back. The shorter duration bonds, they're going to recover much more quickly, and because they expire, because they run out. And bonds, different than stocks, may not necessarily recover in the sense that they, jump back up as quickly. But the short term ones, especially, they get to the end, you get the principal amount back, and it's done, and you roll to a new one. So some of the ways to use bonds that I want to talk about a little bit. And we'll do more of this in the next segment, is how do you use them? Do you just buy one bond? Do you buy a bond ETF? Do you do laddering? What do all those things mean?
There's actively managed funds. Right. There's a wide variety of ways that you can enter that marketplace.
Yeah. So maybe I'll just ask, Randy, what's your least favorite way to own bonds? And what's perhaps one of your more favored ways to own bonds?
I think a standard index of bonds is probably my least favorite because it may be low cost in the sense of acquisition, but there's no active management. There's nobody in there that is looking at the dynamics and making decisions about which bond is the one that we should have. And I like either individual selection bonds, where you actually buy the bonds themselves and hold them to maturity. It's about as exciting as watching paint dry, but they're pretty consistent, and it's easy to do. Bonds are not something that you want to trade on an individual basis. But I think just buying a standard index of bonds, let's say I'm going to buy a 20-year index of a fund that just buys 20-year maturities. I don't like that. I don't like that. I think they're probably and then hold on to them.
Yeah,
anyway.
and they're volatile, and the pricing on that, because they're constantly buying new bonds, they're constantly picking them up. You're not holding things to maturity. It works differently. It works more like a fund on those. So you're going to have the prices go up and down. And we, use some, some are passive, some are active managed bond funds. We use that as part of what we do. But I think we, as many other people, know that's not as stable, I guess, as it could be. If you bought a bond, an individual bond, and you plan to hold it for 30 years, you could kind of forget about what the price may say for the day because you don't care. You're getting the interest rate, you're getting the payment every month. And then you're also getting the life of the bond. And so to your comment, if someone was going to lock in and say, I like these interest rates, I like this asset, I don't want to be concerned about the price of it. You could buy an individual bond and hold it for many years without any real risk.
Yeah. And one of the advantages of what we're going through right now is the fact that yields have risen quite a bit. You can buy a short-term certificate of deposit or treasuries and get over 4% returns on these. And we're talking about less than a year as far as their maturity. So that you're going to get your money back within a year, no matter what happens with the interest rates. And we haven't had those kind of yields now for almost 10 years. I mean, it's a pretty unique situation as we looked over the last decade.
Yeah. If you missed any part of this episode or this radio podcast, you can get us on YouTube. You can also find us on our website. It's retirementunlimited.com. And if you have a comment or an item you want us to discuss on a future episode, some question you've been wondering about, go to our website, retirementunlimited.com, and use the comment section and leave us a note.